7 or 8 years ago, you had a massive shock to the Chinese economy. Essentially, the US imposed a semiconductor embargo on China, and the leadership felt, okay, the US just declared economic war on us. Starting in 2018, you see this very clearly in the lending data. The banks are essentially told by the government, guys, no more loans to real estate, no more loans to the consumer. All the money has to go into industry. BYD has 120,000 engineers in their R&D departments. Now, to put things in context, Tesla has 85,000 workers, not in their R&D department, just 85,000 workers. China today is where the US was in 2009. You guys were around then. You'll remember in 2009, everybody was going around saying, oh my God, it's going to be a new normal. It's going to be low returns for a decade. Who's got access to electricity? Who's got access to energy? If in 2009 it was the US, today it's China. Like China's cost of energy is a fraction of the United States. China today produces more electricity than the US and Europe combined.
You're watching Excess Returns. I'm Matt Ziegler. I've got Jack Forehand beside me today. I mean, am I Batman? Is he Boy Wonder? You know, if he's here, I'm Boy Wonder. We're very excited about this, mostly because this guest name has been mentioned multiple times in a couple of our most recent episodes. Rupert Mitchell, Blind Squirrel Macro, I think most recently said, I am so excited right now because I just spent time with this guest. So he's the guy I look to whenever I really want to know what's going on with international markets, especially China. Louis Gav of Gavekal Research. Welcome to Excess Returns.
Thanks for having me, guys. It's a real pleasure to be here.
Long time coming. Super excited for this. Straight into the deep end. What do you think us folks in the West get most wrong when we're looking at China, their economy and markets?
Oh,
right into the entire podcast. We could probably just ask this and then leave.
How much time do you have? Yeah, are you sure you want to put a coin in that jukebox?
Yes, I do.
All right. Look, I think the first thing people get wrong is they look at China like a command economy because they see the name, Chinese Communist Party on the wall, and they assume this is a command economy, and therefore it can't work. So the assumption of most foreign investors is that if you argue that something is working in China, that must mean that you believe in command and control economies, and B, you're obviously wrong because command economies don't work, and so it's all gonna implode and blow up in your face. And I think this is a fairly Manichaean approach, sort of black and white, which doesn't really correspond to an underlying economic reality. There's no doubt that China was that 50 years ago. When China was under Mao rule, you couldn't even decide what you were going to wear in the morning. Everybody had to wear the same thing. You couldn't decide where you were going to work. You couldn't decide, it was a total command and control economy. But the story really of the past 40, 50 years has been by and large a story of gradual deregulation. First you deregulate labor, then you deregulate land, then you deregulate natural resources. And now we're going through the phase of the deregulation of the world of capital, which, it's these things, it's never a straight line. It's always sort of 3 steps forward, 2 steps back. So I think that's the first thing people get wrong. I think the other thing people get wrong is they underestimate the level of competition that is prevalent around China. Essentially, competition at all levels, including, very importantly, between local governments, which is how you end up in the situation like you have right now, where if you look at China, I think you've got like 100 EV makers, because what happens is at the very top, Xi Jinping says, hey guys, we need to be the biggest EV producer in the world. And if I'm the mayor of Shanghai or the provincial governor of Guangdong or the party secretary in Zhejiang, I go home and I say, okay, if I want to get the next job, the big boss told me I need to produce electric cars. And so I turn around and I call Tesla, if I'm the mayor of Shanghai, and I say, hey, Tesla, why don't you come here I'll give you some free land and I'll give you some free electricity. And then, the state next door, the province next door, Zhejiang says, oh, well, that worked out well for them. Let's do some of this. And so you end up in situations where, as soon as you have a successful business model, you might have 100 competitors funded by 100 different local authorities. And deep down, that's actually quite good for the consumer. Today in China, you can buy a great BYD car with full self-drive for $7,500. And so for the end consumer, it's a good deal. For the shareholders, it can be tough because, as soon as you have what you think is a pretty unique business, there's actually a competitor that gets subsidized right next door. And so, these are the sort of unique characteristics of Chinese capitalism that I think most people who say, oh, well, everything is controlled by the central government who allocates resources, etc., just get completely wrong. It's a very, very different competitive and domestic economic landscape over there.
You mentioned the economic reality now in China. Can you talk a little bit about that, right? What it looks like right now on the ground in China, like how strong the economy is, how things are going?
So I think to understand where you are today, you actually have to go back 7 or 8 years, because 7 or 8 years ago, you had a massive, massive shock to the Chinese economy. Essentially, the US imposed a semiconductor embargo on China, and the leadership felt, okay, the US just declared economic war on us. They transformed what was a trade war into a tech war, saying, look, we just don't want you to move up the value chain, and so we're going to block you from having access to the high-end semiconductors. Now, the government's reaction to this was essentially to say, okay, if they're blocking us from semiconductors today, tomorrow it could be chemical products, it could be auto parts, it could be anything. We have to totally, and it's not just the US, because the US can tell ASML not to sell us machines, it can tell TSMC not to sell us chips. So we have to totally de-Westernize our supply chains. And so starting in 2018, you see this very clearly in the lending data. The banks are essentially told by the government, guys, no more loans to real estate, no more loans to the consumer. All the money has to go into industry because we have to move up the industrial value chain much quicker than we thought we did before. It's a question of economic survival, that we need to build resiliency and independence in our industrial supply chains. And so you had a period for 7 years where all of China's savings, and those savings are massive, all of China's savings essentially went into industry. Now, this represented a massive deflationary shock for China and for the world. It was actually a twin deflationary shock. The first shock was as you starved real estate of capital, real estate prices went down, consumers tightened their belt, property developers went bust, commodity prices went down. This was the balance sheet recession that, everybody wrote about for 7 years. You couldn't pick up a copy of the Wall Street Journal or the Financial Times without being told of this balance sheet recession. But the conclusion people took from it was the wrong one. Everybody looked at this and said, oh, this is Japan all over again. Except that it's not. Because in Japan, bank lending totally collapsed. In China, bank lending all went into industry. And what I think most people missed during those 7 years is how quickly China was moving up this value chain. Now, first, because it had unlimited access to capital, but also, and I think this is the part that everybody underestimates, is over that period, the Chinese workforce dramatically changed. What do I mean? I went to China to university in the mid-90s, and back then, China was graduating 350,000 university students a year. Today, China graduates 12 million university students a year. I mean, no country has gone in one generation, because I'm 52, has gone from 350 to 12 million. It's mind-boggling. So what you had, and by the way, roughly half of these guys are engineers and science graduates. So just at the time when money was pouring into industry, essentially China was also producing just an insane number of engineers. So, you mentioned Rupert in the intro. I was with Rupert visiting BYD, I think 2 or 3 weeks ago. I can't remember, 3 weeks ago maybe. BYD has 120,000 engineers in their R&D department. Now, to put things in context, Tesla has 85,000 workers. not in their R&D department, just 85,000 workers, including the guys on the factory chain, tightening the bolts, etc. So BYD in their R&D department has 50% more workers than Tesla. So anyway, so money absolutely poured into industry. And I think what the world missed was as all this money, as all these human resources poured in, China very rapidly moved up the value chain. If I told you in 2020, guys, by 2023, China will be exporting more cars than any other countries, you would have laughed in my face. And if I had said by 2025, you'll visit BYD and you'll wish you could buy those cars in your country, you would have been like, you would have kicked me out of the room and called me ridiculous. But yet here we are. And so what you've seen on cars, and I think people now realize it, because as soon as you travel, if you go to Brazil, if you go to South Africa, if you go to Saudi Arabia, you see the Chinese cars everywhere. What you've seen on cars, it's the same thing for tractors, it's the same thing for ships, it's the same thing for turbines, it's the same thing for nuclear power plants. It's essentially anything linked to automation and robotics, anything linked to transportation outside of jet planes, anything linked to energy storage, energy transmission, energy generation. By now, China has actually leapfrogged the West, where it's producing, thanks to all these people and all this money that's gone into it, it's producing better products at a cheaper price. So that was I think that the second big deflationary shock. So that brings you to today. Sorry, it's a long-winded answer to your question, but that brings you to today. You have to understand where you are today. You've had this balance sheet recession, this deflationary shock for China, for the world, that was a direct result of essentially a geostrategic imperative. A geostrategic imperative of we need to cushion our economy against U.S. attacks. 2018, the U.S. punches China on the face. China has no choice but to take the punch. So it takes the punch. 21, Biden comes back to power. China thinks this is going to be better. It's actually worse. So China gets punched in the face again, can't do anything except go to the gym, get jacked, get strong. So that by 25, when Trump comes back in, and this time Trump is pissed when he comes back in, and he doesn't just punch China. He punches Canada, he punches Mexico, he punches Europe, punches absolutely everybody because he's angry. The one country that is able to stand up because they've spent the past 7 years getting fit in the gym is China. So, U.S. goes to punch China, says, okay, you want to go? Let's go. Gloves off. Let's go. Let's do this. You tariff me, I tariff you. You embargo me, I embargo you. And that brings you to the meetings in Geneva, Kuala Lumpur, Seoul that we just had, where essentially the U.S. is forced to back off. The U.S. is forced to back off because you have the CEO of Raytheon that says in 3 weeks, I can't produce missiles. You have Ford shutting down factories because they don't have access to rare earths. And so all of a sudden, the main method of pressure that the U.S. has is high-end semiconductors. And China with DeepSeek and with Quen has shown that actually we can do AI without the high-end semiconductors. That brings me to one of my favorite quotes. And I've written a piece about this. It's your listeners who follow me on Twitter can get that piece off my, I've opened it. It's a free distribution on my Twitter. If you go back to World War II, Rommel, the famous German tank commander, would say, our Tiger tanks is worth 4 of their Sherman tanks. The problem is the Americans always show up with 5. And this is where China is today. Today, everybody's running around saying, at AI, China can't compete because it doesn't have the NVIDIA chips. That's like saying the US can't compete with Germany because it can't produce as good a tank as the Sherman tank. When it comes to conflict, when it comes to challenges, there's a beauty in volume. And this is China's comparative advantage. The US's comparative advantage of World War II, which was essentially being the world's leading industrial power and being able to produce 10 Sherman tanks for every one German Tiger tank, that has now shifted to China. And so the US now essentially has no choice but to back down, which allows China to now embrace completely different sets of policies. Sorry, it's a very long-winded answer again, but it's very important to understand this. that 5 years ago, 7 years ago, if you were Xi Jinping, before you put on your pants in the morning, your concern was, how do I cushion my economy from US attacks? That was your number one concern. Today, you no longer worry about this. That ship has sailed. In fact, now it's the US that has to worry, how can I get rare earths? How do I make sure that my car plants don't shut down? How do I make sure that I can still produce missiles for Ukraine, for Israel? That is now, the concern has shifted. Instead, if you're China now, the concern is, my people aren't getting married anymore. They're not having kids. My birth rate is collapsing because, the balance sheet recession has hit the millennials, your 25 to 40-year-olds. It's hit the millennials really, really hard. They've been the bag holders in the balance sheet recession. And so now you have to essentially help those guys out. And so now if you look at the 5-year plan of 5 years ago, it was all about increasing supply. Now the 5-year plan is all about increasing demand. And so today you turn around and China is now running budget deficits of 10% of GDP, second biggest economy in the world. And I think this matters, not just for China, of course, consequences, China's having a bull market, etc. But globally, even if you say, I don't care about what's happening in China, I don't want to hear about it, I hate the place, even if you're the most neoconservative of neoconservatives, the reality remains that for, 7 years, China was a huge deflationary drag for the world. It followed a very deflationary policy, which allowed the US, Europe, Japan to follow very easy fiscal, very easy monetary policies because China was such a deflationary drag. The days of China being that deflationary drag are now going to be behind us. Now, I'm not saying, that China is going to be this big inflationary shock, but at the margin, China's deflationary impact is now abating. They're following much more reflationary policies. And as they follow reflationary policies, you are seeing the impact on the market. You're seeing the impact on the market through the outperformance of emerging market debt, the outperformance of emerging market equities, the outperformance of metals, the outperformance of miners. The one reflationary trade that hasn't really worked yet is energy. But if that does, then we move into a very, very different investment environment.
Part of what's fascinating about that response is within a day of when we put this interview out, we're going to put one out with Ben Hunt on his note about World War AI. And one of the things that's through that piece is this idea of, after a period of easy money, which China and the US both had a different version of making access to capital easier through the pandemic period and everything that went on there, is that energy, labor, time, those are the scarce assets.
Yep.
And I'm curious, contrast maybe the US and China, but give us that on the ground view for the scarcity of energy, labor, and time as it's being viewed in China right now.
So to be clear, capital was scarce in China depending on who you were. Like, if you wanted to build a car plant, here's some money. If you wanted to build a battery plant, solar panel plant, anything, you had money. If you were a consumer, if you were if you were into real estate, if you're a property developer, you did not have access to capital. So this is what's shifting now. The government, through its anti-involution campaign, has essentially told the banks, guys, go out and lend to the consumer, go out and lend to the real estate, and you're done lending to industry. So the access to capital in China, capital was cheap, but it was not available to everybody. Contrary, indeed, to the Western world, where capital was cheap and very, very available. So look, to answer your question, contrast and compare access to labor, access to capital, access to cheap energy. One of my core beliefs is that China today is where the US was in 2009, 2010. You guys were around then. You'll remember in 2009, everybody was going around saying, oh my God, it's going to be a new normal. It's going to be low returns for a decade. It's going to be a lost decade. You remember all this, right?
I was born in 2012. I mean,
Okay, so yeah, okay, so there you go. Well, you can read about it in the history books.
I'll read about this. But those new normal, all those pitches, all those low returns, all those, there's no way we can grow coming out of the
mortgage bust
crisis. Exactly.
Yeah. No, that was the core belief. And in fairness, GDP growth and employment growth was weak from 2009 to 2016. It really was. Like if you go back and look at the numbers.
Yeah, Reinhardt and Rogoff didn't even have AI. And look what happened.
That's right. But so if you go back to then, essentially there were no constraints to U.S. policy, right? There were no constraints to U.S. policy because there was no inflation in the system. And back then, the U.S. had a super cheap currency. The U.S. dollar was super, super cheap. It had the cheapest cost of energy thanks to the shale revolution. Price of nat gas had collapsed, etc. And, with the cheap currency, it had a cheap cost of labor. So you go back to 2009, the U.S. had cheap cost of labor, cheap cost of currency, cheapest cost of energy, and basically unlimited government support. The Fed would do QE1, QE2, QE3, push money into the economy. The economy didn't really need that money because it was growing pretty slowly. The real estate didn't really need that money because the real estate market was on its back. So the money naturally flowed into equities who re-rated. This is exactly what you're seeing in China today. So if in 2009, the cheapest cost of energy, to answer, Ben Hunt's point of who's got access to electricity, who's got access to energy. If in 2009, it was the US, today it's China. Like China's cost of energy is a fraction of the United States. China today produces more electricity than the US and Europe combined. You take a province like Shandong. Shandong is, to put things in perspective, it's like the Michigan of China, if you want. It's a northeast Rust Belt province, a lot of steel production, a lot of rubber, a lot of sort of old industry. Well, between May and September in Shandong, electricity is, during the daytime, electricity is essentially free because they put in so much solar capacity that they can't store it. So this is, what's fascinating to me is if you go back to 2006, 2007, so 20 years ago, the nat gas price in the US was around $10. In the past 20 years, the nat gas price has gone from $10 down to $2, and the electricity price over the same period has gone up 50%. Now, why is that? Because the US has not invested in its grid. Because the grid you have today is the same grid you had 20 years ago. Grids deteriorate, you lose efficiency over the grid, etc. Now, China's grid is brand new. And China's nuclear power plants are brand new, and solar panels are brand new. And so today, China's cost of electricity, because of the investments of the past decade, investments incidentally that we forced them to make, we being the Western world, we forced them to make because they were so worried of essentially being cut off by the Western world that we forced them to up their game. So today, where is there plentiful electricity and cheap electricity? It's in China. Where is there plentiful and cheap labor? If in 2009 it was the US, today it is in China. We wrote a piece, it's also unlocked on my Twitter actually, wrote a piece on productivity. You take the best example of productivity for me is comparing the Shanghai Tesla factory to the Fremont Tesla factory. They produce the same cars. They produce twice as many cars per worker in Shanghai than they do in the US. And the worker in Shanghai costs a fifth of the cost as the workers in the US. And that's for salaries. Forget throwing a healthcare cost on top of it. So the bottom line is that, in China today, everybody's running around saying it's uninvestable. But to Ben Hunt's point, where do you have cheap labor? Where do you have cheap electricity? Where do you have the cheapest cost of capital? And where do you have the cheapest currency in the world? And where do you have now active government support for the markets because you have a government that's actively pushing reflation? So to me, China looks like the US did in 2009, 2010. Everybody's going around saying, it's a short-term rally at best. It's going to be a lost decade. Japan, et cetera, et cetera. Meanwhile, the market grinds higher every day.
One of the things we've been seeing in the media, and this gets back to Ben's point as well, is this idea. The idea of Ben's article was if AI is not going to be as beneficial to the average person as we think, well, the U.S. is going to need a war basically to justify what's going on, and that war would be with China. So how does China view this whole idea of? Do they view like AI as a winner-take-all battle with the United States?
So I don't think that's how it's framed in China, to be honest. But I do think the US and China are on totally different paths when it comes to AI. Again, partly because of the restrictions we the Western world, imposed on China. I think what we've done in the Western world, when you look at ChatGPT, Anthropic, all those guys, is they've looked back at the past 15 years and essentially concluded the big winner of the past 15 years is Apple, because they had a closed-end system where they control their customers, and they can gradually always increase prices on their customers. Some may drop off, but the Apple ecosystem is an absolute wonder to behold, right? And as it became clear that Apple had this wonderful ecosystem, the stock price got re-rated from 8 times earnings to 35 times earnings. All this to say that in the US, the push of the OpenAIs, the ChatGPTs, the Anthropics, etc., has been to try to create closed-end systems where I create a closed-end system and I sell it to big corporates, and essentially they're hostage to my AI solution. China, because it never had the option of throwing computing power on top of computing power to solve problems, because we denied it to them, we the Western world denied it to them, had no choice but to embrace open AI solutions. So it's actually ironic because the US is called the main player in the US is called OpenAI, but is anything but. It's a closed-end system. Meanwhile, DeepSeek, Qwen are very much open-ended systems. And again, I don't think this was necessarily a policy choice by China. It was just what came out of necessity. But what you're now seeing is, I don't know if you guys saw, but Andreessen Horowitz recently declared, one of the biggest VC firms in the world, they recently declared that 80% of the startups that come to knock on their door to ask for money now use Chinese LLMs, and they do so not so much because of the cost, although that might be part of it, but very much because it's an open-ended solution. So you can take the Chinese platform and modify it to your needs. While if you try to do that with ChatGPT, it's going to cost you an absolute bomb because you have to ask them, it takes time, they go back and forth, back and forth. This is essentially what the Airbnb boss also said. The Airbnb at the last earnings results, the CEO said, look, we used to use ChatGPT. We've now switched to Qwen, the Alibaba platform, because we take the Alibaba platform, we got 10 software guys internally who can modify it to our tailor it to our needs, and off we go. And so, for me, the AI war, to use your term, is not a war between, say, US and China. It's a war between conceptualization as to how we're going to use AI. And is it going to be a closed-end system where security is absolutely paramount, which you can have on a closed-end system? Or is it going to be an open-ended system in which functionality is paramount? I think this is the battle line, and most users won't care whether it comes from China or the United States.
Makes for a really interesting angle. I want to take it here too, because this is something that Rupert made very, very clear when we were talking to him. I think he called it full contact capitalism. I think you've talked about it in the terms of China's industrial policy as Hunger Games capitalism.
Yeah.
It's just a different approach. Can you explain what you meant by that and what the advantages and disadvantages are?
Well, the advantage to the consumer is you get better products at a cheaper price. When I was with Rupert and my buddy Cuppy and Shrub and Paolo and all of us were together in Shenzhen, and we went out and we rode out on the BYD cars, which was a lot of fun. And they all walked out saying, like we rode the car that goes 495 kilometers an hour, and we rode the car that can spend 30 minutes as a hovercraft going across a river or a lake. We also rode the 7,500 BYD, car that's full self-drive. And we rode the car, my favorite personally was the one with the drone inside, that, you plug in on your GPS where you're going, and the drone goes about 50 yards ahead of you to warn you in case there's like deers on the road or a tractor or anything like that. So, it's the end consumer from all this competition benefits through lower prices and better products. For the investors, it's tougher. It's a much Hunger Games of capitalism is no fun. So today, BYD is producing great cars, but it's got 99 companies nipping at its heels, crushing its margins. So as an investor in BYD, you might not love that. So it's actually funny because everybody thinks, oh, China's this communist country, etc., where really capitalism is on steroids, and where the competition is, nonstop. Meanwhile, you look at most Western countries, and essentially what we have is corporatism on steroids, where it increasingly feels like governments have been captured by corporate lobbies. So you have, 3 auto producers, and you have, one big software company and one big consumer product company, and et cetera, et cetera. And they make sure that they write regulations to and tax and frankly tax laws. When you look at how Facebook, Alphabet, et cetera, book all their profits in Ireland, and tax laws that benefit them. So it's very different concept of how an economy should work. Now, the end result, I think, is the Western consumer gets screwed. You end up with weaker products. Now, the Western shareholders make out like bandits, and the Western consumers get screwed.
So then talk about the Chinese shareholders, because obviously you can't take Cuppy and his event-driven monitor over there to look at these things. You can't take Shrub over there to look at these things, or Rupert, and look at that from the trading versus investing angle of how we even think about this.
Well, Shrub, investing through memes might work very well in China. So Shrub may do fine. Shrub may still crush it. He seems to crush it wherever he goes anyway. So
clearly.
So Shrub may still be doing fine. No, to your point, look, I think investing in China has been a very tough place to deploy capital, partly because, there's a lot of capital there. They've got a high savings rate. They don't necessarily need your money. So, for somebody like Cuppy, who indeed likes to provide money to people who have access to none, like right now, it's actually, there are things to do. And because you've had a lot of people, whether in real estate, but even in some of the consumer names, et cetera, that have been deprived of capital. So for a guy like Cuppy, there is now actually things to do, and there wasn't before. The way I look at it personally is, it's a tough place to invest. What you have to do is try to you have to look for niches. So either you look for a niche of a company that is advanced enough that it'll be very hard for anybody else to compete. And historically, you never really had those in China because they were always at the low end of the manufacturing scale. So if you could throw money at it, you could always replicate. But you are now starting to see companies that are genuinely original. I'll give you an example of a company I went to visit. Actually, after all those guys had left, I went up to Shanghai. I met up with a company called Hesai. Now they're the biggest. Well, they're pretty much the only LiDAR producer that matters in the world now. Now, there's a big debate around self-drive cars, autonomous driving, whether you should go with cameras or you should go with LiDARs. And Elon Musk keeps saying, "Oh, LiDARs are useless. Cameras are the future." But so that essentially is the debate. Now, I think part of the reason Elon Musk was against LiDARs was that 5 years ago, equipping a car with LiDARs would cost over $35,000 US. So you could see how it's like, okay, that's going to double the price of my car. And nobody's going to want to buy that. Now, Hesai comes along. They now have this a factory outside of Shanghai, and it's not the kind of factory that you imagine in your head being a Chinese factory, with like a bunch of 5-year-olds on an assembly chain. It's anything but that. It's literally 50 engineers. And
see this enginering
just
point
automated.
You said about the ratios before, because this is going to stick with me for a long time. Yeah. Okay.
This is it. It's like 50 engineers, and it's like all automated. The joke in China is that the factory of the future has one guard dog and one guard, and the guard is there to feed the guard dog, and the guard dog is there to bite the man if he tries to touch the machines. And so the factories have changed dramatically. So you look at a company like Hesai, it used to be 35, 40 grand to equip a car with LiDARs 5 years ago. Guess what it is today? It's $200.
200 bucks.
200.
Amazing.
$200.
Wow. Amazing.
$200. So now actually, Hesai's pitch now, and so they've signed contracts with Mercedes, with BMW, obviously with BYD, with Li Autos, with all the Chinese guys. But the pitch now no longer is, oh, you need this for autonomous driving. The pitch is, with LiDAR, fatality rates in accidents go down 90%. So just like every car has to have an airbag because it reduces the fatality rate, actually for safety reasons, every car should have a LiDAR. Now, if you think that's a possibility that this happens, so that's how they're lobbying now in Washington, in Brussels, etc. If that happens, essentially by now they control 75% of the global market, and they're such an efficient producer that they'll control 90% of the market. And nobody, given the patents that they have, it's going to be very hard to compete with them. So in all this to say that in China, you're starting to get these kinds of companies that you didn't have in the past that can own a niche that is a very high-end technical precision niche, which again, like 5 years ago, 10 years ago, those kinds of companies would have been a Japanese company or a German company. And now you are getting them in China. So that's one path that's very exciting because that's new. The other path of investing in China is you either invest in the companies that are, so big that nobody can compete with them, the Tencents, the Alibabas, etc. So a bit the same story. You own Facebook and you own Google because you kind of have to. So that's one path. And to be very clear, Tencent is my single biggest position. I think it's an absolute world-class company that essentially makes sense, makes pennies on every single Chinese person out there. So you can go down that path. And the third path is to say, okay, I'm going to invest in parts of the markets that are highly regulated so that there can't be too much competition, but parts that still have growth. So for example, Macau casinos, or for example, life insurance companies. There's essentially three major players and you're not going to get new ones. So that, that's how you look at it. But yeah, let's not kid around. It's been a tough place to make money.
One of the things we're seeing in the US a lot is this whole idea of the AI CapEx spend. And, is this stuff going to actually produce money? Is it going to be worth it in the long run? And China seems to be taking the exact opposite approach to that. It seems to be a much more capital light approach to AI. So can you just talk about that a little bit? Like the differences in the two approaches and why they're doing what they're doing?
Yeah, no, I'm laughing because indeed, like historically through my career, China, when there was an opportunity to set capital on fire, China would jump on it. Historically, that's just what they did because they were always in a capital rich environment. And this time it is the US that is going down the path of, let's throw money at this. We'll figure out later if there's any returns, whatever. We need to be number one. So we'll just absolutely plow money. It's such a Chinese approach to the world. And yes, to your point, China never had that option, not because it didn't have the money, but because it couldn't buy the chips to do this. And so, for whatever reason, they've all gone. The U.S., China's been, capital smart about the AI development, but also perhaps, in fairness, China had another alternative, which was to throw bodies at this. You look at DeepSeek, they could just throw thousands and thousands of engineer hours onto this in a way that it would have been very costly if you were trying to do that in San Francisco, right? So you could replace I'm going to plow money into this with I'm going to plow man hours into this because my man hours are nowhere near as expensive as your man hours. So, but the bottom line indeed is very much that this time around, it is the U.S. that is proving extremely, extremely capital intensive. It is in the U.S. that growth is now proving capital intensive. And on this, one of my favorite quotes about markets is that, in a bull market, companies get rewarded for spending capital aggressively, and in a bear markets, they get rewarded for getting rid of the things they bought in the bull market. And I'm wondering whether right now we're not seeing that transition. Because you look at Oracle, Oracle announces, hey, I'm going to spend $300 billion on data centers. And the share price rips, but then so does the CDS spreads and the cost of funding for Oracle, as everybody's like, hold on, how are you going to fund this? And then the share prices collapses. So, when it comes to AI in the US, you've gone through 3 years where you were always rewarded for throwing more money at the problem. The more money you could spend at the problem, the more your share price went up. And this may now be ending in front of our eyes. This may, it feels like we're transitioning from all of a sudden, the market is no longer rewarding you for being stupid with capital.
How do you characterize, or how do you think about another sort of like Western projection on this? Is it's the US and Europe, and then it's China and Russia, and we have to think about the world this way still. Is that an outdated way of thinking about this stuff, or is there some truth to it? Give me an explanation.
Well, look, I think when 80% of the US startups that go knock on Mark Anderson's door for money tell you I'm using a Chinese AI, I think it's a statement in itself, right? It tells you that this approach of, we're dividing the world between the good guys who wear white hats and who ride the white horses and who are called democracies, and the black hats who are, the evil autocracies. That's completely obsolete. It's completely obsolete because it also doesn't correspond at all to trade flows, to investment flows. They tried to make it correspond to trade flows and investment flows, and it's been a massive flop. And they're now having to walk it back very aggressively because you've got the CEO of Ford and the CEO of Raytheon and the CEO of Lockheed. This doesn't work for us. We're now. Let's be very honest here. I said everything started 7 or 8 years ago when China had to confront the fact that it had to de-Westernize its supply chain. And China took huge sacrifices to de-Westernize its supply chain. The real estate market went down by 1/3. The stock market went down by 2/3. The consumption took a huge hit. And government debt went up a lot, and budget deficits that were essentially zero are now 10% of GDP. Okay, now, can the US do this? The China went through it and said, I'm going to de-Westernize my supply chain. The US is now saying, we need to de-Sinify our supply chain. That's total wishful thinking. Do you think you could take 1/3 down on real estate, 2/3 down on stock market, a big hit to consumption? There'll be revolution in the streets. They will hang the lawmakers and burn down the Congress if that happens. There's no way there's no way the U.S. can do this. The people won't stand for it. And they won't, because you're also starting from a very different position. You're starting from a position of an economy that's hyper-financialized, where people's leverage on asset prices is enormous, and where you're already starting with a budget deficit of 6% of GDP and 120% government debt to GDP. So the room to say, okay, we're going to spend all this money to reindustrialize. We're going to spend trillions to build up an aluminum supply chain, which will allow us to have a rare earth supply chain. It's not true. It's not possible. The numbers are just too big. So it's not going to happen. And so already I think, the days of, we're all splitting into, good guys versus bad guys, those days are now behind us. And I think that's why essentially Trump is now pushing a peace plan onto Ukraine that is nothing short of a massive admission of failure. The peace plan that Zelensky's asked to endorse is much, much worse than the peace plan that was on the table in April 2022. He loses more land. It's financially ruinous for his country. And so he'll have fought 3 years for this. This is abdication. And so, which incidentally, to your point, it puts on the one hand, the US and Europe against Russia and China. The Ukraine peace, if it goes through, is going to create a huge split within Europe. It's going to tear Europe apart, because what's going to happen in Europe is you have countries that are very eager to work with Russia again. Your Hungaries, your Slovakias, your Czechies, your Germanys, your Austria. They want to work with Russia again. They want to get the cheap Russian energy. They want to sell cars to Russia. They want to they just want to pretend this never happened and let's go back to where we were. And then you have the Poles, the Balts, the Scandinavians. For them, the idea of doing business with Russia is like doing business with Hitler. It's complete anathema. Um, and so this is going to tear Europe apart. So the idea that you have on the one side the nice democracies and on the other side the bad autocracies, and this is how the world will now work, I think is about to get disproven in a massive way by how Europe is going to deal with the end of this Ukraine war and how Europe is going to get split down the middle.
When we take this back to markets, what do you think this means in terms of going forward? I mean, we're used to, as Americans here, we're used to our American exceptionalism where our market outperforms every year, and that seems to be shifting. And, you talked about China taking a hit to the future. I mean, are you pretty optimistic then that as we go forward in the next decade, China is very well set up from a market standpoint in terms of market performance versus something like the US?
So decades is a long time. But I definitely think we've started a bull market in China. Like I said, I think China is where the US was in 2010. And I think we've started a longer term bull market. I think when I look at the world today, if I think of prices that are completely wrong, like prices that are a total anomaly, the biggest anomaly for me is the price of the renminbi. I mentioned the Tesla example, but that week where I was with the boys in Shenzhen and then in Shanghai, and then I went up to Beijing, and then from there I actually flew to the US, and it feels like very often it feels like one renminbi equals $1. I mean, you stay in great hotel rooms for 500 or 600 renminbi. You stay in shitty hotel rooms in New York for $600. The taxi from the airport, which takes about just as long in China, is going to cost you 70 renminbi. In the US, it's going to be $100. And so on and so forth. Food, car prices, phone prices. The ratio is completely wrong. And you see this in the trade numbers, right? You see this in the China today. 5 years ago, China was running a trade surplus of 20 billion US dollars. Now, 5 years into the trade war, China's running a trade surplus of 100 billion US dollar. I mean, it's ludicrous. 100 billion trade surplus is absolutely, absolutely stupid. So for me, this is the number one anomaly in the world today, is the renminbi is so stupidly undervalued. It has to shift. Now, one of the reasons it managed to stay so undervalued is the mantra between 2022 to roughly 6 months ago of China's uninvestable. So foreign investors kept leaving China. This put pressure on the downward pressure on the renminbi. The central bank had to step in to prevent the renminbi from falling. But now, essentially, that narrative has changed. And by now, all the foreigners who were going to sell the renminbi have sold. The foreigners who were going to leave China, by now they're gone. So now you're left with 100 billion coming in every month. And so that leaves you with a fairly easy bifurcation. The first is, as all this money continues to come in, the renminbi has to start drifting higher. And as it starts drifting higher, Chinese savings, which for now has accumulated into gold, it's accumulated into US dollar assets, it's acute to the extent that it could, it's accumulated into US dollar bank accounts in Hong Kong or in Singapore. All of a sudden, if your currency starts to go up, say 5-6% a year, you start thinking, hold on, I can buy PetroChina for a 6% dividend yield. I can buy China Mobile for a 6% dividend yield. I can buy, any number of SOEs for 5-6% dividend yields. Companies that aren't going bust. Meanwhile, the currency is also going up 5 or 6%. So that's a 10 to 12% return with very low volatility. So that's if they allow the currency to go up. If they don't allow the currency, and they being the central bank, if the central bank fights the upward pressure on the currency, that means that they have to print a lot of money. As the 100 billion come in every month, they got to print the renminbi on the other side. And as they print the renminbi on the other side, remember that money that in the past would have gone into real estate, would have gone into economic activity, now has nowhere else to go but the stock market. And that's why I think when you look at the Chinese stock market, you have to build, and it's already looking that way, a sort of barbell strategy, where if the renminbi goes up, you want to own anything with a high dividend yield or a high bond yield. And if the renminbi doesn't go up, you're going to own the aggressive growth stuff because you'll have so much liquidity creation that it will flow into it'll flow into the Tencents of this world, into the Alibabas of this world, and so on and so forth. So the barbell strategy for me, because the RMB is the most mispriced asset out there today, you have to have a barbell strategy of owning Chinese growth stocks and high dividend yield payers.
So we hear over and over again about the demographic story, and I always shudder
terrible.
because it's not good on, especially as a short-term indicator, and the stats are ugly themselves. You're talking about the next 10 years for China. What's the tee up? Where they start now? Can that story get better for China in the next decade?
So I think the demographic picture, if you go back to pre-COVID, China was having roughly 17, 18 million births a year. Last year, China had 9.5 million births. This is an epic demographic collapse. It's now structurally, the trend had been going down, and this is a trend that you see all across Asia. You see it in Korea, you see it in Taiwan, you see it in Singapore, Thailand, Malaysia. Even Malaysia, which is a Muslim country, has a ratio of 1.5 children per woman today. Even India is actually below 2 now. So it's everywhere around Asia, and it corresponds to urbanization. People in cities have fewer kids than if they live in the countryside. It corresponds to women having career choices now, to people staying at university longer. So lots and lots of factors. The fact remains that since China's balance sheet recession, the deterioration in China has been much faster than everybody else. Within the sort of structural downward trend, China's done much worse. And I think that's why the government is shifting course on the whole, we need to increase supply to we need to increase demand. That's why the government is actively trying to push up equity prices, because it's trying to repair the balance sheets of the millennials. Essentially, the millennials, your 26 to 45-year-olds, those guys they've been the bag holders in the real estate bust, and they're no longer getting married. They're no longer having kids. So this is what you have to fix for. And, the way you fix for this, they hope, is, you create an equity bull market and you create animal spirits, and and in so doing, you repair balance sheets, and hopefully people get married and have kids. Now, I don't know if it's going to work, to answer your question, but I also don't care that much. I mean, this sounds really cynical, and I'm sorry, but I'm not in the baby clothes business. I'm in the making money out of stock business.
Not yet. You're not.
Not yet. No. Yeah. I'm not, I don't think I'll be in the baby clothes business or the baby shoe business.
Famous last words.
So if I was in the baby clothes business, I'd be worried. I'd be very worried. But, right now the policy is we're going to crank up stock markets so that people get married and have kids. The part of that equation that matters to me is we're going to crank up the stock market. Whether you succeed on the second part, getting people married and have kids, very happy if you do, good for you. For the next few years, what matters to me is the cranking up the stock market bit.
The other big risk you hear with China, which you talked about earlier, is Taiwan. Like, how much of a risk do you think that is? Like, if you go on Twitter, you'll see people all the time saying, in the next 5 years, they're going to invade and this is going to be a catastrophe for the world. Like, do you think that's overblown?
Yes, massively. My go-to line is the closer you live to Taiwan, the less you worry about it. You'll find that all the guys who tell you, worry about Taiwan, usually live in, Frankfurt, Dallas, or Toronto. You won't find a lot of people from Taiwan or from living on the east coast of China worried about it, because, by the way, partly because if China, if you're living in Fujian province or Zhejiang or along the eastern coast, which is where most of China's economic activity happens today, that means you're in direct range of Taiwanese missiles should anything happen. So, perhaps you should be worried as well. Now, I'll give you the main reasons you don't need to worry about it. The main reasons have everything to do with Taiwan's political backdrop today. Essentially, what you have in Taiwan, the DPP, which is the pro-independence party, which is currently in power and has been in power for the past 12 years, is polling in the low 20s. It's never been this unpopular. So if you're China today, you're looking at this and you think, okay, the election has to happen between now and May 2028. And at the next election, the DPP, which is the party that obviously the CPC in Beijing absolutely loathes, is going to get obliterated. It might not even survive the election. It'll capture so few seats that it might be the end of it. The only way these guys get to survive is if we rattle the cage. And so China has every incentive to not rattle the cage for the next 2.5 years. Then the KMT comes back to power. And once the KMT is in power, you open the checkbook. You sign lots of deals, lots of tourism deals, lots of this, lots of that. And you start negotiating in good faith with the DPP. And remember, what the Chinese leadership wants is some kind of deal that puts a date and a transition. You know, when they did Hong Kong in 1992 and they agreed on 1997 as 1997 was the date where the new territories had to go back. But, you know, the reality was that all of the water and pretty much all the food for Hong Kong was coming for the mainland. So in 1949, if the communists had wanted to take Hong Kong, they could have. But they didn't. They never forcefully tried to take Hong Kong. It was always through negotiations. Now, when it comes to Taiwan, I think ultimately what will happen is you'll get some kind of a deal where the Chinese will tell the KMT, but they'll only tell the KMT if the KMT gets 2/3 of parliament, because to change the constitutions, you need 2/3 of parliament. But if you get 2/3 of parliament in the upcoming election, then China says, okay, look, for the next 50 years, you get to stay like you are. You get to stay, you keep your army, you keep your police, you keep your currency, everything stays the same. Then the following 50 years, so first 50 years, basically status quo. Next 50 years, you move to the one country, two systems like Hong Kong. So you keep your parliament, your elections, your currency, your police, you just don't have your army anymore. So that brings you to 100 years. And then in 100 years, we merge. And who knows what China looks like in 100 years. And whoever signs up on this deal anyway is long gone, long dead. And so I'm absolutely not worried about Taiwan. And I'm not worried about it because unlike, say, the Russia-Ukraine situation, there is no bad blood. You know, if you look at the Donbass between 2014 and 2022, you had 10,000 dead. So every day when he was waking up, Putin was getting reports of, they banned Russian Orthodox churches, or they banned the speaking of Russian, or such and such school has been shelled, or such and such hospital has been put on fire. And then he'd have this whole right wing saying, what are you doing about this? You know, we need to intervene. We need to do something. There was a lot of bad blood. There's nothing like that in Taiwan. Like Xi Jinping doesn't wake up every morning to news reports and part of his party saying, what are we doing about this? Because nothing bad is happening in Taiwan. It's not like the Chinese language is being banned. It's not like religious ceremonies are being banned. It's not like people are getting killed. There is absolutely no bad blood. There's so little bad blood, in fact, that more than a fifth of Taiwanese male passport holders aged between 25 and 65 actually work on the mainland, and very often are married to Chinese women and have Chinese families. So it is such, for me, the Taiwanese issue is this sort of red herring that is brought up by, to be honest, the U.S. military-industrial complex to justify the buying of the next aircraft carrier or the next nuclear submarine or the next, fleet of F-35s. If you're the U.S., you have to justify $1 trillion in military spending when no one can invade you. And, how do you justify this? Oh, because because China's going to invade Taiwan. So, anyways, I'm not worried about it.
All right. Before we ask you the standard closing questions here, the bull case, how could you be wrong? What worries you where you could be wrong besides, you didn't get long baby shoe manufacturers or whatever the most insulting trade would be?
Look, there's many ways you can be wrong in China. But right now you're still left with, foreign investors that aren't interested, and that aren't there. So for the market to go down, you have to have essentially local consumers that are really down and out, and that aren't that exposed to stocks. Today, China households have 170 trillion in RMB at the bank against a market cap of 100 trillion. When in the US, you have a market cap of 70 trillion and 9 trillion in cash at the bank. 170 trillion is in renminbi, and in US, it's in US dollars. But so, in China, you have a cash to the market ratio of 170%, and in the US, it's about 15%. So, when I look at overall exposure, I'm not that worried that things are going to go collapsing in China. Now, bull markets in China typically end when the governments decide, okay, this has gone on too much. We're going to change the rules on reserve requirements. We're going to change the rules on margin lending, etc. So far, there's no sign of that. If that happens, then you change your mind. You're like, okay, the government is no longer pushing the stock market higher. They're trying to push it down. I'm done. You cash in your chips and you walk away. So far, like I said, I don't see that shift in policy from the government, but what do I know? They could shift in 3 months, in 6 months, for whatever reason. But again, so far, I don't see it. So that was, for me, I would really change my mind if there was an important shift in Chinese government policy.
Well, our first standard closing question, I feel like we could probably come up with 20 things from this interview that you could answer, but I'll ask it anyway, which is, what is one thing you believe about investing that the majority of your peers would disagree with you about?
I don't know if they'll disagree. It's just like one of my starting points, and I'm not sure this is controversial and they disagree with it, but one of my starting points is that exchange rates and the cost of energy matter tremendously. And so I spend a lot of time looking at exchange rates, looking at purchasing parities, and I do like buying undervalued assets and undervalued currencies because I think you get a twin protection. And now, to be very fair, this has not been a very successful strategy in recent years, where the US dollar was overvalued and US assets were overvalued, but they kept outperforming. But so, for me, and again, I'm not sure people would disagree with me if I said, look, I think currencies matter a lot, and the undervaluation of a currency is going to end up being a big driver of return for forthcoming years. I don't think anybody would stand up and say, well, that's bullshit and that's stupid, etc. They'll just quietly ignore it. But that is one of my core beliefs.
And if there's one thing you could teach the average investor, what lesson would you like to teach them?
I don't know if I'm in any position to teach anybody anything. I think the main thing about investing, there's no right or wrong way to go about investing, right? There's many, many different ways. And you have to find the way that sort of fits your personality, fits your weakness. The tough part, I think, when you're young, is you don't really know where your weaknesses are. You find out your weakness by doing it. And obviously what you need to try to do is avoid putting yourself in positions where your weaknesses are found out. One of the best ways to do this, I find, and I do this, and I recommend it to young people that I meet, is actually to keep a diary. And not just to keep a diary, but to reread your diary, so that you can put yourself back into the mindset you were in, the decisions you took, why you took them. So I'm not sure it's a great piece of advice, but it worked for me.
I'll say so. I'm going to take that as a great piece of advice. Louis, Gav, we want to thank you for your time. If people want to read more online, I know, plug the Twitter handle, plug the website. Where can we send people?
Yeah, the best is actually the website. I don't tweet that much. Most of what I tweet is stupid jokes that make me laugh, but very often very few other people. So my Twitter handle is Gav_Vincent, which is my middle name. The best place to find us is actually through our website, so Gavekal.com, Gavekal.com.
Well, I think you might not get invited for the Chinese factory tour next time, but you want to follow along with Louis' work so you can get all these insights, because not too many people are talking this way. And if the returns in the last year are any indication, if we're off to something, you got to find somebody who gets this. Louis, thank you so much for joining us today.
Thanks a bunch, guys. It was a pleasure to be here.
Thank you for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on your favorite audio platform or on YouTube. You can also follow all the podcasts in the Excess Returns Network at excessreturnspod.com. If you have any feedback or questions, you can contact us at excessreturnspod@gmail.com.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the firms of the hosts or their clients.